ERM is still pretty immature, I would say, certainly relative to some of the theoretical frameworks that you will read about. That doesn't mean that it's a failure. It means that it is a way of managing, a way of thinking that I think does take a great deal of time to implement. I think also given the times that we're in terms of the financial stress, the recession that's going on, has people focused on the downside, avoiding problems. And in all markets, in all scenarios, all cycles, when you say the word risk, that is generally the thought that comes to mind, avoiding problems. But in order for ERM to really blossom into its sort of full potential, I think you're going to be hearing just as much about the upside of good risk management. Good risk management doesn't just mean avoiding problems, it means taking advantage of opportunities. It means seeing around corners, to use that hackneyed expression. But companies that can bounce back faster, that have better backup, that have plan B and plan C to put into place, that thought about these things, stand to be in a position to gain financially from that. We haven't seen much evidence of that. And I think once you do see that, I think companies will become more, shall we say, committed to investing in ERM. So we've seen so far a fairly rudimentary approach to ERM. I think what I would say heat maps are fairly common, as a tool that people will use. Risk inventories are fairly common. The operational aspects of ERM, I think, are pretty well underway in a lot of companies across sectors. Where we don't see very much is in the way of thinking about emerging risks, kind of the new issues that haven't occurred before. We don't see too much in the way of clear expressions of risk tolerance and risk appetite. This is strategic level stuff. But for a company to think about and articulate where they want to be on that risk-return trade-off is something that when you go to grad school, you think all companies do that. You'll see the theory, but in practice, it's actually pretty rare that companies will be able to articulate that. And there are some important people that need to know about that. Employees are one, because they're the people that are taking the risks. And while everyone has policies and procedures and manuals and guides to border behavior, or to govern behavior of people, it's pretty rare, at least what we've seen so far, pretty rare that companies will have a clear way of communicating to their employees how much risk they want them to take. And in industries that are less quantifiable in terms of the risk, it's much harder to do. In the financial world, in the energy business, where the risks are more measurable, it's a little easier to do this. You can tell an underwriter in an insurance company or a trader on a desk, this is your range of authority. If you go over this limit, you're in big trouble. And by the way, we expect you to do at least this much business. So there are some metrics in place there. But for the most part, companies haven't come to grips with this kind of strategic intent statement about where they want to be in terms of risk appetite. I think this is a slow-moving train. I think that companies are, over the next few years, will become more comfortable with the language of risk management. I think the biggest trend or the biggest change we're going to see is at the board level. And that change will come through some combination of kind of self-realization or regulation, or a combination of the two. I think that some of the methods by which boards are being compelled to more consciously think about risk are a little heavy-handed from the regulatory standpoint. For example, the proposal to mandate a risk committee on the board. I talked to board members who say that's kind of silly because the board at large is the risk committee. They're taking on risk. But today, most Most boards don't handle risk at the broad board level. They handle it in the audit committee of the board, and that's probably not the best place for it either, at least from a strategic standpoint. Ultimately, I think it will be, however the organization of risk is done, I think that boards will be more engaged with risk. I think they'll hold management to a higher standard. I think there'll be more interaction about risk. I don't know that there'll be more chief risk officers. That's kind of a trend that some people see. I don't really see that yet. I would say that the chief risk officers where they exist don't tend to have the visibility that they would need to have to really be effective at that. That's a generalization, but that may be a mini trend. If we see more CROs, maybe we see them with some more influence and more power. I think you'll see, in addition, I think you'll see more conscious attention to risk management in industries where previously you might not have heard that term. So I think it's going to branch out from energy and agribusiness and pharmaceuticals, where it tends to be a little more ingrained currently, and into retail and consumer products and industries that are maybe less engaged with risk management. Finally, the other trend I would point to is a complete rethinking of risk management in financial institutions. The scope of discussion we've had today has been about the non-financial world. That's where this initiative is focused. We've already been doing enterprise risk reviews in financial institutions, and needless to say, that has required a complete rethink, both from ourselves as observers of these institutions and in the institutions themselves. I think the E in ERM has been a small e, and sometimes altogether missing from risk management. That is the enterprise. When you think about enterprise risk management, it doesn't just mean those risks that affect everyone in the firm or every business of the firm. It means that seemingly unrelated risks could in fact be correlated with each other. And it means paying more attention to the aggregation of risk across what you think would be completely different businesses and different locations and different customer base. But hey, guess what? The price of gold goes up and both of these industries, both of these businesses are affected, or the price of oil goes up, or a regulatory change happens, or whatever that stimulus might be. So maybe the biggest trend that we'll see in ERM going forward is more focus on the E, more focus on enterprise-wide.